At first glance, if you look at flips, they look pretty good. You put in $100,000 of renovations for half a year, and your property price goes up by $250,000, so that's a very fast $150,000 in just half a year. But it's not that simple. Real estate has high transaction costs, plus land transfer taxes and capital gains tax, so if you start crunching more numbers, you'll find that your net returns after everything might only be around $30,000 for that one project. You might think that's okay for a side hustle. If I do more projects, they'll start adding up, and because I'm flipping, I'll be able to do a lot more projects than just buying and holding real estate and waiting for rental income and market appreciation to slowly build up. Now, I know different people have different investment strategies, but our goal here at Elevate is to help you invest smarter. If you're putting in a lot more effort in taking on bigger and possibly riskier projects, then you should be compensated a lot more for it. So, how do you think big flips actually compare to buying and holding? Is it really worth that extra work and risk? Let's find out. Before I dive in, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you can see more videos like this made specifically for real estate investors in Toronto. In case you don't know, a real estate flip is when you buy a home that needs work, renovate it, and then once you've made it much nicer, you sell it again for a higher price, hopefully for a profit. Now, I've already made a video talking about why you shouldn't flip houses, and the main reason is because most of the time, the costs end up being higher than your gains. If you crunch the numbers, you'll find that smaller flips typically lose money. So right off the bat, if you're thinking about flips, then you'll have to take on major projects to even make money. As I mentioned already, returns per project are not particularly high, but they can add up if you complete a large number of them in a short period of time. But instead of me just talking about it, let's go right into the numbers to see what returns look like if you have around $400,000 of capital for house flipping. With this budget, you can buy a $1.2 million house with a 20% down payment and then put the rest into a $100,000 renovation that takes around 6 months. And then if you sell it right after it, you might end up seeing it off your books at the end of 9 months. For this project, let's assume you make $150,000 in value add appreciation plus $26,000 in market appreciation over half a year. And then if you add them up, it looks like a very good $176,000 gain in just 9 months. But like I mentioned, we can't forget about the costs. When you buy and sell a house, you'll have to pay interest, selling and legal fees, land transfer taxes, capital gains tax, all of which add up to $143,000. This means your actual net returns end up being only $33,000 on this project. But now, if you add that to your initial capital, you'll have more money to work on your next flip, and you can continue flipping houses once a year until you reach the end of year 10. Now, the projects you take on can get bigger and bigger, so your net returns on future projects will also continue to grow. By the 10th project, the net return is $67,000 for that project. And if you add up the returns from project 1 to project 10, you'll see a total return of $483,000 or an annual ROI of 8.5%. Now, if you think about it, if you put $400,000 of capital in stocks, you'll be able to make an average of around 8 to 10% in ROI per year, or 6 to 8% after taxes, and it is a lot more passive. Given that you're already using borrowed money to invest in real estate and you're putting in a lot more work for flips, the ROI doesn't seem that high. And again, that's because the expense and tax ratio are pretty substantial for flips. So instead of flipping, let's see how your returns would look like if you held that first property that you flipped until year 10. When we do that, on top of getting $176,000 from value add renovations, we'd also continue to get market appreciation and rental income until the end of year 10. Now, if we use a 4% annual appreciation and a 4% net rent yield for returns, you'll find that the total gross returns from value add appreciation, market appreciation, and rental income grow to $1.25 million. The costs, on the other hand, don't grow as much, so the expense and tax ratio gets a lot less, and therefore the net return on this one property would be $554,000. In other words, keeping the first flip for 10 years will actually make you more money than flipping 10 of those houses in 10 years. But that's not all. If you get enough equity built up in that first property, then you can also refinance that property and take out extra cash so that you can use that money to buy a second place without selling the first one. Now, you might not be able to buy that second property as quickly as a flip. In fact, right after renovations, your property only goes up by $176,000, which means you can only take out 80% of that, or $140,000. It looks like you'd have to wait 6 years to get enough equity to buy the next property if you also want to take on a big renovation project for the next one, to give you a total of $396,000 cash to take out from refinancing. Now, after running these numbers, you'll find that the net return on the second property would be $334,000 if you hold it from year 6 to year 10 and then selling after that. Adding the returns for both properties together, we're looking at a total return of $889,000. So here we have a much more passive investment strategy and much better returns. So we have a win-win solution here. We now know that a big renovation and holding it is better than flipping. But what about investing in turnkey properties as a long-term investment? How would they compare? Well, with the same budget, you can actually afford a bigger purchase because there are no renovations needed. Instead of a $1.2 million property as a purchase price, you can buy a property that's $1.6 million. A bigger purchase means more absolute appreciation and more absolute rental income. After selling it in 10 years' time and deducting expenses and taxes, you'd still make $570,000 here. So get this, your returns on one turnkey property is actually higher than doing 10 flips or even doing one big reno as a long-term investment. How does that make sense? Well, the main reason is because of leverage. If you're purely looking at buying and holding without renovations, your loan to value ratio is at the highest at 80%, so you're buying the property with a lot of borrowed money. In the renovation case, after renovating the property and before refinancing, your loan to value ratio becomes 70% because you have to put in cash for renovations and you bumped up your property price by upgrading the property. As you can see from this example, lower leverage can make a big difference in your returns. And so your leverage is lower, which means your returns won't be as good. But of course, there is something that you can do if you want to make your money work harder for you in the renovations case. If you are able to refinance, then you can increase your leverage, buy a second property, and make more money from that. And when you do that, you will see higher returns by renovating compared to turnkey properties. And perhaps your last question is, how would the turnkey solution look like if I were to refinance that first property and buy a second one within the 10 years? Now, because we are relying on market appreciation, the equity we can refinance in year 6 would be less than what you can take out if you did a big renovation up front. At year 6, we would have $345,000 to reinvest, which is enough for a smaller investment where you can net $219,000 between year 6 to year 10. If we add up the two property earnings together, we will see a total return of $790,000. Now, this is more in line with what we expect for turnkey properties, where they're supposed to generate lower returns compared to investments with renovations required. So, if we take a step back and learn from these examples, there are 3 key things that I do want to highlight. The first takeaway is that buying and holding, even choosing the most passive type of real estate investment with just one turnkey property, will generate better returns than flipping houses continuously based on the same budget and investment time frame. But this doesn't mean putting in sweat equity isn't worth it, because it can really be a good idea. But if you are up for a renovation project, then I recommend that you buy and hold instead of selling right after renovating. This will lower your expense and tax ratio, so you will generate better returns on that project. The third thing you should know is that renovations actually lower your leverage if you're using more of your own money for renovations. Lower leverage translates to lower ROI. So if you want to maximize your returns, then you would need to refinance that property to bump up your loan to value ratio back to closer to 80% to make your money work harder for you. We're big believers in doing value add work and long-term real estate investing. And if you want to chat more about this, we're ready to help. We can look at your requirements and your preferences and then match you up with the best investment opportunity that fits your needs. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.